For decades, General Motors stood as a symbol of American industrial might. At its peak in the 1950s, the company commanded nearly half of all car sales in the United States and employed over 600,000 people. Its name was synonymous with success, innovation, and the American dream itself. Yet, on June 1, 2009, this automotive giant filed for bankruptcy, marking the largest industrial collapse in United States history. The fall of General Motors wasn't the result of a single catastrophic mistake. Instead, it was a slow unraveling that took decades, driven by management complacency, strategic failures, and an inability to adapt to a changing world. The story begins in the company's golden age. General Motors was founded in 1908 by William Durant in Flint, Michigan. Durant rapidly acquired more than 20 brands, including Oldsmobile, Cadillac, and what would become GMC Truck. By the 1920s, under the leadership of Alfred Sloan and Pierre DuPont, GM revolutionized the automobile industry with a simple but powerful philosophy: a car for every purse and purpose. While Ford offered one basic model in black, GM provided different brands at different price points, each with distinct styling and prestige. Chevrolet for the budget-conscious, Pontiac for those moving up, Oldsmobile and Buick for the middle class, and Cadillac for the wealthy. This strategy, combined with innovative financing and yearly model changes, propelled GM past Ford. By the mid-1930s, GM captured 42% of the market, while Ford shrank to 21%. The company had created a blueprint for corporate success that would be studied for generations. Throughout World War II and the post-war boom, General Motors dominated like no company before or since. It became the first corporation in American history to pay over $1 billion in taxes in a single year. In 1955 alone, GM employed 624,000 Americans. The company's market share peaked at an astonishing 54% in 1954. Its president at the time famously declared before Congress that what was good for the country was good for General Motors and vice versa. For many Americans, this seemed true. GM's success provided well-paying jobs, supported entire communities, and helped build the American middle class. But beneath this success, cracks were beginning to form. The very dominance that made GM powerful also bred complacency. The company that once obsessively tracked consumer preferences and outmaneuvered competitors began to coast on past glory. By the 1960s, foreign automakers started gaining ground. Volkswagen's Beetle and Japanese brands like Toyota offered something American consumers increasingly wanted: smaller, more fuel-efficient, and more reliable vehicles. In 1963, only 5% of cars sold in America were foreign-made. By 1967, that share had leaped to 13%. GM's initial response was dismissive. These small foreign cars seemed like mere irritants to a company of such massive scale. When GM did respond with vehicles like the Chevrolet Corvair, the results were often rushed and flawed. The fundamental problem was that General Motors had stopped doing what made it great. Instead of leading innovation and carefully studying market trends, it became reactive and bureaucratic. The company's multiple brands, once a competitive advantage, became a burden. Each division pushed for its own models in every market segment, creating redundancy and inefficiency. By the 1980s and 90s, the differences between a Chevrolet, Pontiac, Oldsmobile, and Buick had blurred so much that consumers struggled to justify paying more for supposedly premium brands. Meanwhile, GM remained wedded to what had always been profitable: large cars and trucks. Throughout the 80s and 90s, these gas-guzzling vehicles generated enormous profits. Sport utility vehicles and pickup trucks offered 15 to 20% profit margins, compared to just 3% or less on smaller cars. As truck and SUV sales climbed from below 25% of the market in the 80s to over 50% by the early 2000s, GM doubled down on this strategy. The short-term profits were impressive, but this focus left GM dangerously exposed. At the same time, the company accumulated crushing financial obligations. Generous contracts with the United Auto Workers Union in the 1950s and 60s had seemed affordable when GM was flush with cash and had many workers supporting few retirees. But as GM's workforce shrank and its retiree population ballooned, the math became unsustainable. By 2005, GM had one retiree for every 11.5 active workers. Just a few years later, that ratio had deteriorated to 10 retirees for every single active employee. The company was paying billions in healthcare and pension benefits to nearly 900,000 retirees and their dependents. These legacy costs gave foreign competitors a massive advantage. Toyota's benefit cost advantage was estimated at $350 to $500 per vehicle. GM was essentially competing with one hand tied behind its back. The company was hemorrhaging money well before the 2008 financial crisis delivered the final blow. In 2005, GM posted a loss of $10.6 billion. Between 2005 and 2009, the company lost more than $80 billion. Its market share, which had peaked at 54% in the 50s, had withered to less than 19% by early 2009. The stock price that had reached $93 in April 2000 fell below $2 by mid-2008, hitting levels not seen since the 1940s. Then came the perfect storm of 2008. Oil prices skyrocketed, reaching a peak of $147 per barrel in July. Gasoline prices soared above $4 per gallon across much of the country. For American consumers, filling the tank of an SUV suddenly cost more than a week's worth of groceries. The market for GM's most profitable vehicles collapsed almost overnight. Sales of light trucks and SUVs plunged by 26% in May 2008 compared to the previous year. At the same time, the global financial crisis froze credit markets. Car buyers couldn't get loans, and automakers couldn't access the capital they needed to operate. Nearly 2 million cars had been purchased in 2007 using home equity loans. By 2008, that funding source had virtually disappeared. Overall vehicle sales in America crashed from 17 million units annually to just over 10 million. GM sales fell by 30% in 2009, the steepest decline of any major automaker. The company was burning through cash at an alarming rate, spending roughly $2 billion per month just to keep operating. With banks unwilling or unable to lend and sales cratering, GM ran out of options. In December 2008, the Bush administration provided emergency bridge loans totaling almost $20 billion, using funds from the Troubled Asset Relief Program. The loans came with strict conditions. GM had to develop a viable restructuring plan or face bankruptcy. CEO Rick Wagoner was forced to resign. Bondholders rejected government settlement offers. Efforts to sell off European operations stalled. On June 1, 2009, at approximately 8 o'clock in the morning, General Motors filed for Chapter 11 bankruptcy protection in Manhattan Federal Court. The filing listed $82 billion in assets against $173 billion in liabilities, making it the fourth largest bankruptcy in United States history after Lehman Brothers, Washington Mutual, and WorldCom. It was the largest industrial bankruptcy America had ever seen. The government provided an additional $30 billion to fund the reorganization. Taxpayers ended up owning 60% of the new company. The bankruptcy process moved with remarkable speed. Using Section 363 of the Bankruptcy Code, GM split into two entities. Valuable brands and operations were transferred to a new company backed by the government. Pontiac, Saturn, Hummer, and Saab were discontinued. Over 10 plants closed, and more than 20,000 jobs were eliminated. The old GM became Motors Liquidation Company, left to settle past liability claims. Just 40 days after filing, on July 10th, the reorganization was complete. The new General Motors emerged leaner, with debt reduced from $54 billion to $17 billion. The company refocused on core brands, Chevrolet, Cadillac, Buick, and GMC. The bankruptcy of General Motors sent shockwaves through the American economy. Communities built around GM plants faced devastation. Suppliers, dealerships, and entire supply chains hung in the balance. Estimates suggested that an uncontrolled liquidation could have cost over 1 million jobs. Beyond the immediate impact, the fall of this once unstoppable giant forced a reckoning. How could a company with such dominance, resources, and history collapse so completely? The lessons are clear. Success breeds complacency. GM stopped doing the hard work that built its empire, closely tracking consumers, aggressively responding to competitors, and aligning structure with strategy. It became too big, too bureaucratic, and too resistant to change. The company prioritized short-term profits over long-term sustainability, loading up on legacy costs while ignoring fundamental shifts in the market. When crisis struck, decades of poor decisions came due all at once. Today, General Motors has returned to profitability. The company emerged from bankruptcy, returned to the stock market in 2010, and eventually repaid much of the government assistance. But the automaker that filed for bankruptcy and the one that emerged are fundamentally different entities. The old GM, with its century of history and dominance, is gone forever. What remains is a cautionary tale about the dangers of hubris, the importance of adaptation, and the reality that even giants can fall.